want to start by saying I'm really glad to be here and thankful. Last night I was in urgent care. I've got 4 kids at home, but normally urgent care with one of them. It was for me. I had an allergic reaction to something. I don't know what it was. You can't see my forehead flow red today. So we're going to get a steroid shot, and I thought, anywhere today, I want to be in a room with doctors. If something else happens. So if I start wheezing or wandering aimlessly, you can you got a heads up on what's going on. So Foster Group, just real quick on who we are, what we do. We've got offices in West Des Moines and Omaha. So I drove down from Omaha this morning. And why we're in the room specifically. So this number right here, we've got close to 2,000 clients across the country. Over 600 of those clients are physicians. So we work with a lot of doctors and their families and even hospitals and medical clinics, running say 401ks or retirement plans for them. So got a good understanding of unique needs, things that you all are dealing with at whatever stage of career you're in. But a few other things about us. We were founded in '89. We do manage close to $4 billion in investments for those clients. And between our 2 locations, 86 employees. We're completely independent, gang. So everybody breathe. I'm not going to sell you an insurance policy or everybody's annuity or try to convince you to do things that may not be in your best interest because we are a fiduciary. I don't know how many of you are familiar with that term. You're all fiduciaries. You're doing what's best for your patients and clients. And in clinic, Foster Group is the same. We're doing what's best for our clients. Inside of our laws at Foster Group, we are internally owned. We've got 29 shareholders, which I'm one of those, and multi-generational. Why we say that is it's really aligned in the statement how we're different than most of the other advisory firms. Some of you in here may have an advisor. Okay. Foster Group is super insulated against, say, outside private equity or what capital being bought out. So we are today, so we'll be tomorrow. These are the things we do for our clients. So if you work with an investment advisor or you know of an investment advisor, most of them are going to invest your money. And we do that for our folks. But the other 3 things are just as important. That's why it's equal on the screen. We do a lot of financial planning. That's really our bread and butter is helping folks create a roadmap for the future. We don't sell insurance, but we want to make sure our clients have the right amounts. And then that final piece over there, impact, both estate planning, charitable giving, making impact with individuals' resources. Super important in what we do. I won't spend any time on this. If you want copies of this, or I think we're going to have this recorded for people to have available as well. But we can get a slide deck out to you as well. Again, just more of a encyclopedia version of what we do at Foster Group. But I like NAFP rides, and so this is one of my favorite. When people say, well, what do we do? This is one way to describe it. So we live in a world of lots of noise today. Our job is really to help filter that noise down to information that's relevant to you, relevant to our clients, so that people can make rational decisions as opposed to be led to, well, what's the news yelling at me to do today? Or what did I read in the newspaper? Or what is, one of my partners in the break room going to actually be doing? So, before I go to the next slide, if you notice the title on the front screen, it was questions that physicians are asking now. Okay. So as I said, we work with 600 plus physician families and organizations. We've done a lot of work with NAFP in the past, similar associations and societies in South Dakota, Iowa, here in Nebraska, Denver. Spent a lot of time speaking. A lot of times what we're doing with physician groups is we're talking kind of financial 101, just kind of the basic building blocks of making good decisions with your money. We recently did a podcast with the Iowa Medical Society, and they wanted to do a talk on things that physicians are asking now, like what's relevant, what's top of mind for physicians when it comes to their own personal finances. And we got a lot of great feedback, so I thought, well, shit, we're going to kind of pattern that podcast and deliver it today. And certainly this isn't an all-inclusive list. It's kind of like what we're hearing from our physician clients and what the physicians over in Iowa are asking. So I would assume maybe some of you have some of these same questions as well. So try to add some light into that. But any questions that you do have along the way, just, I don't know how long we have. I know you all don't want me to talk for an hour, but how long do we have?
You have an hour.
Yeah. What? Oh, so No particular order here, but first question here. How do I deal with potential cash flow crunch for declining reimbursements? Yeah. So there's probably a few of you who have felt this or are feeling this or will feel this in the future. This isn't a map to scale, but let's just pretend this red line are reimbursements. Green line is cost of doing business, insurance, taxes, technology, etc. The things in the other room, right? So really what we're talking about is a cash flow crunch. Now, the way I answer these questions today are not necessarily from like a professional standpoint as you as a physician. It's really more about you as an investor, you as a manager of your own wealth and finances. So this list here, so the first one is know your financial baseline, okay? How many in here have a budget? Okay. So you got to do that. You got to know what it takes to live. Okay. And then even further, if possible, you want to identify what's discretionary and what's fixed. And I know that sounds like really boring and arduous and probably more work, but it's important. Okay. Second, you need to have an emergency fund. Okay. You'll get sick of this answer and seeing this on the screen. But emergency fund is the number one prudent principle in creating a good financial plan and having financial security. So what does that mean? Typically 3 to 6 months worth of living expenses. And the only way you know that number is if you do first audit, okay? Identifying what it costs you to live. Funny, I was driving down here from Omaha this morning and a commercial on the radio station I was listening to did financial advice in 1 minute. And the whole 1 minute was spent on having an emergency fund. Through this for today. Third bullet there, liquidity beyond retirement. How many are saving into 401k or 403b or SEP IRA today? Is everybody in here? Okay, through your employers? Most physicians that we work with do a really good job of saving into their employer's retirement plan. Okay. What a lot of them do not do or think about doing is saving outside of retirement. Okay, and it's not just in a bank account, it's in a brokerage account. It's in other things that are taxed differently and are available sooner than retirement. So again, really important to kind of insulate yourself against that cash flow crunch with declining reimbursements. Kill debt early. We all know the importance of that. The sooner you can get out of encumbrances, not owe somebody else some money, will give you more flexibility. Diversified income. This can look like a lot of different things. I would say from our experiences with our physicians, you all know this better than I, but some of the things that physicians will do over the course of time and prep for the future, or maybe where their interests take them, are teach, consult, work for an insurance company in the form of claim administration or reviews, other things out there that potentially can, again, insulate from that capital crunch. And then finally, avoid lifestyle creep. When I talk to residential groups, typically, young physicians, they don't like this one so much. Because those ones are hard, because I just had a meeting with a young doc, anesthesiologist, just joined Foster Group this past week. He was 30 years old, 4 kids, got his first paycheck as an actual doctor, right? And he told me his annual income, what it was going to be. And, it's just like they're going to Disney World, right? And it's just the most exciting thing ever. And my greatest piece of advice to him over the course of that hour was constantly reminding him of this thing right here. Just next 2-3 years, manage your expenses, get ahead of debt, get ahead of savings, get ahead, build an emergency fund, do the things that may run counter to the fact that now all of a sudden you're making money. Okay? Really important. Busy slide, I'll only spend 10 seconds on this. Just know that with additional cash and margin, okay, before you run into any cash flow crunch, there are lots of things to do with your cash, okay? Yeah, emergency fund number 1, all the way down to, down there is just saving outside of retirement.
Sorry, I clicked.
You can leave that there. That's one too. Go back. So again, some of these things some of you may be doing today. There's limits on some things. There's tax benefits on others. Things like 529 plans, maxing out Roths. So again, when you think about planning, there can be a lot of strategy involved in every additional dollar that you have and what you do with it specifically. So helpful to get advice unless you have time to figure this out at the same time. Next question, okay? That physicians are often asking now, pretty similar to the first one. So I'll go through this one pretty quick, but how do I handle potential cash flow crunch when hospitals stop contracting with my group? Okay, so if you think about, hey, this is the primary flow of income for our group per se, and the hospital is threatening either a contract renegotiation or just completely avoiding it, what's it look like for me as a physician from a personal financial planning perspective? Okay, so same thing, cash flow crunch, prepare for the inevitability. A lot of times, there's a couple of things that we always tell our physician clients to prepare for, even if it never happens. Certainly death is one, that will happen, okay? Disability, being sued, okay? And then something along the lines of losing a contract or that declining reimbursement. So prepare for it, inevitably, emergency fund. The third one, line of credit, what that means is, so most of you in this room probably have a credit card. Okay? That's a form of a line of credit, but it's a pretty costly one if you carry a balance on that. So a line of credit is really in regards to having a personal line of credit, say with a bank or a home equity line of credit. It doesn't mean you have a balance on that. It just means it's access to cash in an emergency. Okay, and typically at a much lower interest rate than say a credit card. Okay, so cash flow crunch, having access to liquidity should you need it to support lifestyle. Pause discretionary spending, and everybody's got a different number on that. It's not a fun one, but important in times like this. Negotiating with lenders. You may already know this, you may not, I'm going to tell you. Banks and lending institutions love to work with all of them, okay, as physicians. Because we tend to all make a pretty good level of income, and you all like to buy really nice things. Okay? I know that's stereotypical, so I'm not trying to lay that all on you, but the lion's share of physicians that we'll work with, those are pretty attributable. So those lending institutions do not want to lose you as a client either. So if you get into a cash flow crunch and you are paying off debt, and you could certainly benefit from maybe say a pause or deferment or a lower interest rate or a lesser payment schedule, contact your lenders. It's just like buying a car. I mean, you can negotiate with them and they will negotiate with you. Okay, just play your positioning card. Diversifying income, we talked about that on the last time. Relationship connection strong. This idea of avoiding cash flow concentration, it's kind of like investing. If, as a physician with your group, you're only contracted with one outlet, obviously there's risk in that, right? So it's just identifying that on the front end. If there are ways to avoid that or just diversify who else you're providing services to and through, that should be really important. Okay? All right. My favorite was one of my favorite questions, okay? Is now a good time to invest, or should I wait until things feel more stable? Who thinks, let's take a poll here. Who thinks now is a good time to invest? Okay, I'll sit on. Okay. And sometimes I'm one of those people who just never raises their hand, so I get it. Well, that's good. So we're all familiar with everybody's Nebraskan neighbor, Warren Buffett. He had he's got a lot of famous quotes, but I really like this one. Time in the market is more important than timing the market, okay? So just to make sure everybody understands what that means is having your dollar invested over the long term is more important than trying to figure out, should I invest today or should I hold it back and invest next week because things will feel more certain, more stable. That would run counter to how Warren would suggest you invest. So some things to think about. Define uncertainty, okay? So uncertainty, if we were to take a poll in this room as to what uncertainty looks like and feels like and is specifically, we'd probably come up with a wide range of answers. So just know that when one person thinks things are uncertain, relatively speaking, and another feels very certain in what they're doing. So there's always a buyer and seller on both sides of that. That second bullet there, uncertainty usually needs clearance. Okay, so things clearance. Who remembers the blue light specials at Kmart? That'll tell the ages. So March of 2020. Remember what they were doing in March of 2020? Or yeah, well, yeah, right. Things felt pretty uncertain at that time. Okay. But if you had $1 to invest in March of 2020, that dollar is worth a lot more right now. Okay. When things feel uncertain things are typically on sale, okay? So if you wait for certainty, if you wait for whatever that feels like, typically things are going to cost more, okay? So just ask yourself, would I rather buy something at a lower price point or wait till it costs more and then buy it? Well, we know where you can control this black part here, okay? Emergency fund, that's the thing, right? Time horizon, super important, okay? So what do we mean by that? If you're sitting on, well, I'll just come with an example here. Let's say you accumulated a cash amount in a bank of 100,000, okay? Let's just use that number for instance, $100,000, okay? And you're sitting there looking at that and thinking, shit, that's a lot of money. What should I be doing with that, okay? So the conversation we're going to take you through, or any advisor or yourself, what you should go through this litmus test of, okay, what's my emergency fund? Is my emergency fund part of that 100,000? Okay, and if it is, you need to take that out of the equation. Okay, so let's say your emergency fund needs to be 30,000. Now we're left with 70. Okay, and then let's say you're going to buy you're going to replace a car in the next year, and that's going to cost you. Let's say you're going to spend 30,000 on that. So now instead of at 70, we're at 40,000. Okay, because that 30,000, we know we're going to spend it in the next 1 to 3 years. I'm not going to invest that. Like, we don't need to lose money on money that we're planning to spend in the near future. So we got 40,000, and now, well, okay, well, we don't necessarily need that money anytime soon. Let's go ahead and consider investing it. So you have to go through this process of what do I need this money to do? When do I need it available to make sure you aren't investing at an inopportune time in your life? It has nothing to do with what the market's doing. It has everything to do with when you need the money. In this last video, this is really important, dollar cost averaging, to reduce regret for those of you who are nervous about maybe investing or investing a lot at one time. For those of you who are saving into a 401k or a 403b, or deferring a certain percent of your salary into a retirement plan, you are dollar cost averaging, right? You're putting money into the market, into investments incrementally over the course of time. And why that's important and why that's kind of an emotional hedge is, if you took that, let's take that $40,000 earlier and you invested it all today, and tomorrow the market just went, okay, you'd feel pretty bad, okay? But if you took that 40,000 and you invested, say, 10,000 over the next 4 months, and the market, no matter what the market did, you feel pretty good. You got some money in, it up, you left some out, it went down. So, emotional hedge. Couple pictures here, just to kind of reinforce this idea of why investing, no matter how you feel about certainty, is still important. This is a chart full of uncertainty. A rapid base quake, dot-com crash, S&P 500 down 46%, COVID, Brexit, it's all across the board, right? But what's the theme of that dollar invested in 1970? Well, it's about the right, but it's up and to the right. And that dollar today is worth, nearly $120. So uncertainty just means that there's opportunity at the same time. This is kind of a fun one. A lot of times people define their uncertainty based upon who's in political office. So again, red's Republican, blue's Democrat, same thing, right? The market doesn't really care who's in office, right? So never let that be a predicator upon what you're doing with your money as far as investing goes. This runs to 2024. If we were to throw 2025 on there, again, same thing. Market's doing great. Doesn't mean there are bumps in the road, but politics tends to have nothing to do with how the market is performing. And then this last picture here, those top bluish jagged lines, those are more about investing in, say, large companies versus small companies in the U.S. And then these lines down here, more bonds, cash, inflation, what they're doing. So really, in the end, the question is, hey, if I just want certainty versus uncertainty, well, there's your opportunity cost, right? I mean, you're looking at numbers that, investing in U.S. companies over the course of time, you're at $40,000 if you invested that dollar in 1926 versus, say, you're at $24 investing in only U.S. T-bills. Significant difference. Okay. I should take a pause. Any questions so far? Anything spark up? And I'm happy to take questions along the way or at the end, but if you do,
Yeah. So what percent of your income should you have for disability, like 50%, 60%?
So let me make sure I understand your question. Are you saying how much you want your disability to cover?
So let's say if you have disability insurance, you want it to cover 60% of your base salary, 50%, 80%. I don't know. Does that make sense?
Yep, it does. Yep. My answer to that is as close to 100% as possible. Because what tends to happen in a situation of disability is that costs for life, especially if you have a family as well, will go up even further. Like you will end up spending more than what you were doing before. And you still need to eat, you still need to save. Or, there are things that will continue to go on. So most people, that becomes pretty difficult to do. I'll talk about disability before we finish up today about some important things around disability insurance. But you certainly, most employer-sponsored disability policies will cover, say, around 60%. Okay. But be mindful of this, okay? A little nugget, okay? If you have an employer-sponsored plan for long-term disability insurance, and that premium is either being paid by the employer or you're paying it with pre-tax dollars, your benefit will be taxed, okay? So it's important if you have the ability to pay premiums yourself with post-tax money, that's really important because when you're getting that benefit in disability, you want every dollar. You don't want to be taxed on that, okay? So most people don't recognize that until they're in disability insurance. All right, another common one, can I manage my investments rather than hiring an advisor? Another poll, who's got an advisor in this room? Okay, community halfish, okay? So the answer is absolutely yes. You can manage investments on your own, okay? Like, you're all smart people in this room, right? You're way smarter than I am. You went through a lot of medical school and you're doing things that most people go and dream about doing with your brain power. So certainly you have the ability to manage investments yourself, okay? But I just challenge anybody who's in that camp to just start with the why. Like, why do you want to do that? Do you enjoy it? Do you think you can do better than anybody else? Do you have the time to do it? So just kind of go through that exercise yourself. Ultimately you have the time, desire, and objectivity. And that objectivity is probably the most important part of that equation because, as you all know, whether you're going to the store to buy milk or you're buying a car, money's emotional. Like the ability to make rational decisions with your dollars can be challenging for most people. And when you're doing your own investing, like it is more than just picking stocks. Okay. It's all these things you see here. Some of those may be familiar than others, but rebalancing a portfolio, knowing when to shift things from bonds to stocks, to large companies to small companies, tax mitigation. There's a lot of tax ramifications in investments. What accounts to set up, when to execute Roth conversions, managing emotions. Okay, so typically the best answer is this. Okay, so if you have some interest in managing your money, but you also want to have that emotional hedge and the planning, etc., it is typically good for folks in your industry because you've earned the right to do that with your level of income to work with somebody. Okay. But you want to make sure they're fiduciary, right? You want to understand how they're paid. You want to go through that due diligence to make sure that you got somebody that you absolutely can trust. This is a fun little deal that Vanguard does every day. So most of you are probably familiar with Vanguard. They're one of, if not the largest money managers in the world today. And they created this white paper years ago and they update it every year. And basically what they're trying to do is they're determining a value that you all should expect when you hire an advisor. Okay, so it's kind of maybe hard to see the screen, but they're going through everything from like how much value does an advisor provide in rebalancing a portfolio or managing emotions or asset locations, spending strategy, etc. And they annually come up with a number right around 3%. Okay, so if you're kind of waffling in that territory about do I work with an advisor or not, just know that your expectation in hiring an advisor should be a return above and beyond costs of around 3%. So there is value. There should be value. And if you don't find that in a relationship, either look elsewhere or do it yourself. Alternative investments. Do those make sense? Some of you in this room may have alternative investments, and what we're talking about, are that top line there. So as opposed to like stocks and bonds, real estate, cryptocurrency, precious metals, franchising. Again, start with the why. I had coffee with a physician client the other day, and we sat down, and he's a critical care doc. His brain's always all over the place. He's been really successful. And within the first 5 minutes, he wanted to do all those things in that first line. It was just, I was worn out after 5 minutes. And I asked him, I asked him that question. I said, why? Why do you want to do this? Why do you want to do these things? He did not have a good answer for me, other than that what I helped him determine on his behalf was that he's just anxious. He feels like he's behind. He feels like he needs to do something other than kind of the norm of what quote everybody else is doing to get ahead. And then I showed him his portfolio return and what he's done just by simply playing the game of investing concurrently over the course of time. It's like, oh, okay, you're squarely on track. You don't need to do anything. Doesn't mean those things are bad, but know why you're doing it. Make sure it fits your plan, and then understand the risk associated with it. Because there are varying levels of risk in all those things. And, just a few notes down there below. I'll kind of read through those if you can see that very well. But like with real estate, obviously we all own real estate is a good thing. Most of us own homes, maybe a second home, maybe some land. There are tax benefits associated with it, but there's a lot of illiquidity, right? And back to this doctor, he thought owning maybe an apartment building, it's just things that are just going to create time and complexity and steal away from what it is that he does. Right, and certainly he's a doctor. Cryptocurrency, that is the latest and greatest over the last few years, certainly. Most of us couldn't even explain it. So if you can't explain something, certainly don't invest in it. But a lot of upside, but certainly well unregulated. Owning a franchise, again, that's it's something to potentially dabble in, whether you want to own it passively or be super active in it. Gold down there, precious metals. We certainly hear about how those are a good hedge against inflation, and that can be true. But just remember, things like gold or silver, they don't create income like a business does, right? If people own shares of NVIDIA, NVIDIA is generating a ton of income through their AI and technology. You own gold does not create income. It's just worth whatever somebody's willing to pay for it. So it's kind of a fun chart. So back to 1990, gold certainly had a nice run the last few years. But if you look at $1 in 1990, essentially versus the S&P 500 at where we're at 2025, it's just substantial difference. And this chart is not meant to advocate for investing only in stocks versus, say, gold, but it's just understanding the trade-offs. What are the opportunity costs associated with going one direction or another? Okay, getting down the home stretch here. We're doing good. So another question, very common. Some of you may have asked this of yourself, but we'll be asking it. But should I pay off student loans aggressively or invest instead? And the way I'll answer this question really is, let's just put an X to the student loan, like student part. Like, I think it's a fair question to ask, do I pay off my debt or invest, right? Which of the two do I do? Or do I do them at the same time, okay? So some things to think about here. And again, I know the student loan portion shows up again in that question. Kind of a disclaimer here. So for those of you who are or will be or could be involved and enrolled or available or eligible for a loan forgiveness program, okay, whether it's public, whether it's through your employer or state, federal, kind of take that one off the table, right? Meaning like, if you think that's a distinct possibility, well, then you probably shouldn't pay off that debt too soon, right? You ought to see if that thing can play itself out, all right? Or at least be super conscious about the potential of having that debt forgiven. But then beyond that, really your first marker in deciding, do I pay off debt faster than invest, or do I invest more than I pay off debt? You just want to compare the rates associated with both. So simple example, if you've got, let's say you've got a bunch of credit card debt, and interest rates on a credit card may be 15%. Okay. So you got 15% costs associated with your debt over here, and you know you could invest $1 and earn somewhere in the range of 7%. Okay. Well, the math would suggest that you need to pay off that debt much faster than you need to invest those dollars, right? You're just guaranteeing yourself a rate of return if you kill off that debt sooner than invest. Vice versa, if you've got a home mortgage that's, some people were able to get them in the 2% range not too terrible long ago. And you know you can invest $1 and earn 7% annually. Right? The math would suggest, well, shoot, I ought to invest faster than maybe aggressively pay off this debt. So that's the exercise you need to go through. Also be mindful of an after-tax benefit. So mortgage interest, that's deductible. Okay. Growth on investment returns in a brokerage account, that's taxable. So you need to factor in how taxes play in that exercise as well. But I will say in the end, killing debt is always a good answer. Okay. I've never sat with a client or met a client or met anybody who was disappointed at the payoff for debt. Being debt free. It's just, it's a milestone and we celebrate that with our folks. That last one, they're careful not to limit your liquidity. So some people are heck bent on paying off every last dollar of debt before they do anything, including set up an emergency fund. And that's super dangerous, because if you think about, well, I'm just going to pour every last dollar into my student loan and my mortgage. Well, shoot, what if a cash flow crunch arises, right? You have nowhere to go to get additional liquidity in that time of emergency or whatever's happening. So you just want to make sure, typically the right answer is to use some sort of a balanced approach. Okay. So go through those exercises, that math, and then determine where does it make most sense to maybe lean, but then make sure you're tackling both at the same time. Don't end one versus another. Questions on anything there?
Yeah. So for student loans, if you have several different ones with different interest rates, is it better to pay off the highest percent ones first separately, or to consolidate them all into one big one?
Depends what consolidating will do for you in the form of an interest rate, right? So again, that's kind of a math equation there. So you can consolidate and move the higher interest rate ones down to a more manageable interest rate, and also comes with more friendly payoff terms versus, to your point, like, well, I've got a super expensive one over here, I'll just chill that thing now. So it's a little bit of lay things out and then see what the right approach. I can't give you maybe just a canned answer on that. So it does somewhat depend as well. And certain loans are treated differently from either a tax benefit perspective, or again, maybe a variable rate perspective. Right now, interest rates are starting to come down. Some loans will adjust their interest rates, others will be fixed. So knowing what maybe the trajectory of interest rates are headed as well. So I know that didn't give you an exact answer, but again, just kind of depends. So there's no wrong answer in that, right? I mean, if you've got expensive debt, you certainly want to tackle that as soon as you can and not let this idea of consolidation be kind of the magical answer to the solution here. So it never hurts to just at least start tackling that as soon as you can. Yeah.
Who's gonna
Rich. I'll take it. Rich.
you're and this is maybe the younger people crowd. There was a point where I wanted to do that. And I did it for a while, didn't do very well, because I didn't have the time. Raising kids, starting practice, doing all those things. I'm an expert in medicine. You're an expert in fun. And I say this to you to say, look for people like this, that and someone that you seem to connect with, both you and your spouse connect with. I think that's very important. I think the fiduciary part is huge. I've seen parents get to the age of from some people. So I think that, and it's really fun to sit back and watch what you're seeing, because all of you in town should be sitting in a really comfortable position every time you get to be a 70-year-old man. Yeah. Even though you may have a ton of debt right now because student loans and those things, do the right things, you will have a much more.
Thanks for saying that. We like to use the phrase winning by brute force, because that's how most physicians can ultimately reach success financially, is just doing the basics, the blocking and tackling. As unfun as that sounds, or boring as that might be, it's like I coach some of my kids' athletic teams, and one of my common phrases with them is that boring makes you better. So if you think about like doing layups for 10 minutes, or shooting free throws for 10 minutes, or hitting out the tee for 10 minutes, it's like, oh, that kind of gets boring after a while, right? I mean, if you're a 5th or 6th grade girl, that gets boring. That will make you better if you do it right. And it's the same thing with everything we're talking about today. It's like, it may seem boring, but it will, when you think about the risk reward associated with it, it'll put you in a much, much better spot. So, okay, it's kind of scary one just because it's real and we see it a lot now. Not a lot, but enough. But how do I prepare financially in the event of position burnout and I need or want to leave practice early? So you know that number over there, positions are 82% more likely to experience burnout than those in other fields. So statistically, some of you in this room are going to experience this. You just followed numbers in numbers. And so how do we help? How do you as a physician prepare for this? Okay. This is going to be some of the copy and paste repeat of some of the earlier answers, but again, boring makes you better. This is really important. So how do you prepare for burnout? Well, just expect it. Okay. And if you don't experience it, then you're just going to, it's all better, right? But expect what burnout might lead to. And so, start early, meaning build flexibility and plan accordingly. You may, simple example, most people, when we say, when do you want to retire? Well, they always kind of start with age 65. Like, that's just the magical number, right? That's when you're eligible for Medicare. Tends to be where a lot of people start getting them up on Social Security. So 65 is kind of number. Okay. So, all right, let's at least model out what it looks like to retire at 65. But then ultimately, when we start putting things in motion, savings patterns, killing debt, etc., let's shoot for age 55. Right? So that we can accelerate this prep and prepare for maybe an early exit, whether it's burnout or just your interests or lie elsewhere. Let's aim for financial independence at a much earlier age. And so, that establish a career flexibility fund beyond the emergency fund. So maybe rather than 3 to 6 months of cash, maybe you have something in the range of 6 to 12 months or plus of cash, knowing that, again, you're preparing for something down the road that maybe you don't have any control of. Aggressively say, a lot of times it's kind of a general rule of thumb for all investors and savers is to annually put away somewhere between 15 and 20% of your income. That may sound like a lot, I don't know. But aggressively saving is almost doubling that, okay? And again, if you live like a resident early as the income continues to ramp up, that really won't be too difficult. But the more your lifestyle creep builds in, saving that amount of income will be tough. Reducing encumbrances, so obviously killing debt, parallel income options, talked about that earlier. So disability insurance, that question came up earlier. Not all disability policies so burnout can be ascribed to, say, mental health. All right, so it could be something where you literally are leaving work because of a diagnosis that could or could not maybe be covered under a disability insurance policy that you have. So don't just ever check the box and say, I had disability insurance, I'm good. Okay. We need to understand what provisions do you want to make sure inside of that policy pay out in the event of any number of things, including burnout relative to mental health. And then this other piece here, some of you may have heard this 100 times other than maybe the first time, but make sure your disability insurance covers you for your specific occupation. So if you cannot do what you specifically do as a physician, that disability policy will pay out, okay? A lot of disability insurance policies will only pay out if you can't do anything. So, the stereotypical Walmart greeter, right? If you can't be a Walmart greeter, then the disability insurance policy will pay out. But as long as you can do something to earn money, it's going to pay out, right? So it's uncovering what's within that insurance policy. You may not be able to do anything in regards to the policy that's provided to you by your employer, but most of you, if not all of you, should have additional disability insurance above that. So an individual policy that then you can craft specifically for things like having own occupational provisions in there. Again, we don't sell any of that, but it's with all our physicians, we're making sure that they've got that. If not, more when if they need. And then last one, I talked about, don't ever plan for retirement. Plan for financial independence. You may love what you do and want to work until you're 80, okay? But knowing that you can turn it off at any time once you pass a certain threshold and achieve this financial independence, that's rewarding, that's freedom. Yeah. All right, last question in regards to what are the common things that physicians are asking us often, at least recently in the last 12 to 24 months. And again, I probably should tell some friend, like, how did I come up with this list or how do we come up with this list? So if you remember, we did this podcast with I don't know, Society. They kind of had a list of things that their physicians were asking. We got 30 advisors at Foster Group, so queried them. And so collectively, we came up with this list. And I don't think you have to be a physician to ask this question, but this is something that physicians do often ask. And this chart gives us a sense for, statistically speaking, when do physicians retire? These two numbers. So 65 or earlier, 41% of physicians, statistically speaking, retire. So it's kind of a reasonable spread in and amongst all those age ranges once you get north of 60. But the question of what do I need? How much do I need to retire? Well, it depends, of course. It depends in every situation. So anytime we're asked the question, we ask the question in response to the question. And so if you're working with an advisor, these are questions you need to be asking yourself to really identify how much do I need to retire, right? So what are your goals? Do you carry debt into retirement? What's your lifestyle at that point? Where do you want to live? How many homes do you want to have? What's your family health history? Is there a possibility of long-term care stay? Do you have multiple buckets to draw from? So it's not uncommon for a lot of folks, physician or not, to save just boom, 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 all their life into a 401k and ignore everything else outside the 401k. And all of a sudden, when they get to retirement and they pull money out of their 401k, what happens? Tax. Every single dollar is taxed at their ordinary income tax rate. They have no ability to mitigate how much tax they're paying on Uncle Sam because they only have one bucket they've consistently saved in over the course of time. So two people in the same situation, same stage of life, same goals could ultimately, in the same lifestyle, actually, one person can need less money than the other because they've got different buckets to draw from and thus pay less in taxes. Whereas if you only have a 401k or 403b that was saved into pre-tax, just know you're going to have, taxes due once you start drawing out of that. So there are two strategies. Again, you're just doing some napkin math on your own. Two strategies that people tend to at least start with when they think about how much do I need. You can probably start doing numbers in your head as you sit here, but first one is called the income replacement method. Kind of the hallmark of that is aiming for 70 to 80% of your income in retirement, okay? And why not 100%, okay? Because in retirement, you're not going to have a goal of saving, okay? We're going to be spending. In theory, your taxes are going to be lower. There's going to be changes in lifestyle. So that's at least a starting point. That's not the answer for everybody. But if you think about how much do I need to retire, well, if you go through the math and you're only replacing 40% of your income, then you're probably not ready. But other things go into that: Social Security, if you have a pension, other income sources, etc. And then the one down below, so 4% rule. This is a lot of academic literature on this, and some people love it, others hate it. It's just a rule. It's just a starting point. And what the 4% rule suggests is that a sustainable withdrawal rate in retirement. So if you think like, okay, what happens if I have $2 million in retirement? Okay, so if I have $2 million in retirement and I take out 4% a year, that gives me what? 80,000 a year? Did I do right out there? Someone checking for me? Okay. So 80,000 a year, okay? So it's like, according to a lot of academics, if you just do some math, there are 4% annually on 2 million, 80,000. You would expect maybe a growth rate on your investments of 7%, you have 3% inflation. So what you're trying to do is just maintain the purchasing power of your dollars by only pulling out 4% from your portfolio in the course of time. So you can see how you kind of back into like, can I live on $80,000? Or maybe can I live on $100,000? Social Security's going to pay 20. So again, a lot of math, but it does give you an idea if you're directionally correct, really, at whatever point, whatever it is that you're aiming for. Again, from an advisor perspective, like our team or any advisor that you're working with, they're obviously going to go much deeper than this. But if you're just kind of starting to map things out and figure out, okay, where am I headed, or you're doing things on your own, those are some starting points to use.
I think that's another important thing that you provide, and that is looking at the future. And I mean, you guys have these get the names of the different software things that you plug in all the numbers, and you change one variable and this one out, and be able to look at those things. We don't have access to that, or be able to figure those things out. And that shows you what doing certain small things, but small things over a long period of time, makes a huge difference.
Yeah. I mean, my kids are telling me I'm getting old all the time. So, but many of you in this room are relatively young, and your greatest ally is time. Like, you can win my brute force. Time is your greatest ally. Compounding dollars can make an enormous difference. And just the same, making a minuscule, costly mistake that goes unnoticed for 5, 10, 15, 20 years can also cost you a lot. So it works both ways. Appreciate the comment there. So last slide here, and then again, any other questions, but we always kind of like to end this because a lot of times, regardless of who's in the room, people they want an action item. They want to call to action. They want to go out and do something, right? If they're motivated at all to manage their dollars. So some of the stuff on here, maybe I'll click. Some of you may have done all these, some of you may not have done any, or maybe some that you're in the midst of, but kind of this to-do list, things that you could honestly do within the next week, or at least address, and kind of moving around the continuum here. Documents, start building your team. So all of you have certainly earned the right to have CPA, an attorney, an insurance specialist, so someone who's specifically focused in on insurance, not doing a lot of other things. Financial advisor who's focused in on advising and planning, not selling a bunch of stuff. So a team that works conjointly together for you. Track your spending, build that emergency fund. I think that's probably 10th time of said emergency fund in this. Identify and address insurance needs. Okay, so how do you identify needs? You go through a planning process. You don't go see an insurance salesman and ask them what you need, because guess what they're going to tell you? You need it. Yeah, you know, let me show you what I can sell you. And I apologize if any of you are married to an insurance salesman, or you like, I have plenty of those in my life too. I can get them back. Implement a debt strategy, initiate savings and investing. Boy, I didn't implement that very well. After tax, right? That's really important again, just to get on that. You're all probably doing a good job of saving into your employer retirement plans. Make sure you're bringing money outside of retirement as well. And then finally there, estate plan when appropriate. So certainly if you're single, no kids, early in your career, probably don't need to winnow the well, if you want the government to decide, I mean, that's your choice. But if you have a young family, you're building life and a balance sheet, get that estate plan done. It's really scary when we meet with folks for the first time and they have 4 kids at home and a couple homes and this and that. And it's like, yeah, we don't have a will or trust, or yeah, we did it online, or we wrote it down on a piece of paper and somebody signed it. They have it. Government will have their own ideas if you pass. Like they'll tell you where your money's going, regardless of what your intention for during your lifetime. Anything else, gang? I didn't have an allergic reaction, so we have different. And yeah, some good questions, thoughts along the way. Anything else? I'll leave some of my cards here. If any of you do have questions, you know, I always hesitate to ask for questions because a lot of you may have questions, but there are things that are specific to you, and maybe you don't want everybody else to hear. So, foster group, again, we're considered a fee-only firm, so we only get paid when we're actually hired. A lot of times we'll do a meeting or two, offer up some second opinions, and give you some direction without ever having to hire us. So again, there's things that you just want to bounce off us and explore how it is that we might be able to help. Just reach out. I'm happy to do that.
The other old head in the room, but
Yeah.
residents, I've had a financial advisor since I was a first year resident. We've got all that debt. Work with someone that's worked with physicians, because there's a game we can play. I have the same IRA that we've been backdooring for years. And they can play the game, and you know, I'm married with kids now, and we are okay. And I'm only 39, and that's nice to know now, so that I can go, I don't know if I like medicine anymore in 10 years versus having to work before. No. I know it sounds like money you don't want to spend right now, but it is work.
Yeah, again, and if you're going to hire an advisor and pay that advisor, you should expect a return, right? They should be doing something for you above and beyond what you're paying them. And if they're not the advisor for you, or get rid of them. I asked the doctor last night, like, how long until, like, do I know, like, this medicine or whatever you just did to me is working, or should I come back and see you? They gave me a time frame, and so what I would say with you and an advisor, like, if you go with an advisor and in a week something doesn't feel right, get out of there, okay? Hiring a good advisor is all about trust, but you gotta trust them, all right? Now, investment return, that can be predicated upon how the market's doing, but you gotta trust them. If your discerning side says, I don't feel like they're shooting straight, get out of it, life's too short, okay? I will leave some of these behind and you can check on, so we've got some shirts at Foster Group. So here's the first one, okay? It says, trust me, my medical degree is way better than your internet search.
I have one of those, and believe me, you will get the
And well, what's funny is like, as a work Foster Group, like I have several of these in my wardrobe and I'll wear them, and physicians will come up and start talking to me as if I'm a physician. No. This is another popular one. This is my cold physician shirt. Okay. So I'll leave some of those over there, and if there's any left, just take them home and partake in that.
Thank you.
Yeah, do that. So, okay, thanks, Dan. If anybody does want to chat, I don't. 10 minutes, we're going to start, but I won't run out of here quite yet.